Hi everyone, my name is Razeen Ahmad and today I'll be presenting my thesis, Predicting Stock Momentum Using Machine Learning and Natural Language Processing. And I completed this with a lot of help from Professor Ward, Professor Chang, Professor Lou Leash, so big shout out to them. So first, I think we're all familiar with the efficient markets hypothesis, the idea that all publicly available information is actively priced into the market. However, this hypothesis isn't perfect. Stock momentum is actually a known anomaly to the efficient markets hypothesis, and it was actually first used in 1967 to create a profitable trading strategy. And then in 1993, Jagadish and Titman proved that the profitability of that strategy wasn't due to exposure to systemic risk factors like the ones identified by Fama and French. And the profitability of that strategy was shown to persist even as recently as 2012. So we know that stock momentum is an anomaly, but we don't have a clear-cut explanation or understanding for why it is. This is where machine learning can help. To better understand this anomaly, I can use machine learning to investigate or understand if there are some sort of underlying firm characteristics that can adequately explain stock momentum. And machine learning can identify trends that previous research may have never even considered or overlooked. And this actually happened in research areas like fraud detection and loan default rates. Specifically, I'll be using natural language processing to capture the information contained within press releases and earnings calls. And past research has actually found that the tone of earnings press releases are correlated with investor reactions in the short term, as well as their cost of equity over the longer term. So how am I going to actually do this? Well, to give a general overview, my models will be trained to take in a number vector, where each number represents some sort of firm characteristic like revenue or earnings call tone. And then it will use that information to predict stock momentum, either high momentum or low momentum. And I can measure the accuracy of my models by testing it on historical data and comparing it to what the firm actually realized historically. And by training different models that use different firm characteristics as inputs, I can compare model accuracies and determine which firm characteristics have stronger predictive power over stock momentum. So I pulled quarterly financial statement data from CompuStat and quarterly earnings call transcripts from Capital IQ. Then I used Python to parse and calculate the metrics I needed, like revenue or tone. Although I had many different models at my disposal, I only used random forest and support vector machines in my analysis here. And I chose these models because they best fit the size and range of my dataset. And they were implemented using Python machine learning libraries. So as I mentioned before, I needed to compare accuracies across different models. So how did I change and modify models? One change I made was how momentum was calculated. There's actually no singular definition for how momentum is calculated, but I decided on two. One definition simply measured how a stock's current price compared to the average over its past 6 months. And I'll be referring to this in this presentation as 6-month momentum. And the other definition compared a stock's return to this S&P 500's return over that same time period. And I'll refer to that as market adjusted momentum. So by modifying how momentum is calculated, I can derive insights about which type of momentum can be more accurately explained or predicted by machine learning. I also changed whether the model used natural language metrics from quarterly earnings calls or not while making their momentum predictions. This allowed me to test if natural language metrics actually improve the model's ability to predict momentum. In other words, can natural language metrics from earnings calls explain stock? I also changed the window size, or how much historical data the model used for each prediction. And lastly, for window sizes greater than 1 quarter, I also changed if the model used delta or non-delta inputs. And this simply changed whether my models considered the raw metric values over time or the change in those metric values over time. And this would allow for my models to incorporate the trend over time for some of these metrics, especially since my models, the random forest and support vector machines, don't by default already incorporate some of those temporal trends. It's not part of how they're designed. I ran my models across the 12 companies listed here, and these are across 6 different industry sectors. There are actually 11 total industry sectors, but I only had enough time to train my models across these 6. So how do my models do? Well, to measure if my models were actually able to predict momentum with any meaningful accuracy, I compare my model's accuracy with the model that always predicts high momentum. It doesn't actually do any advanced processing. It just always predicts high momentum. And I call this model the naive model. So the percentage figures here that you're seeing, this is how more accurate on average my models were compared to that naive model. So for 6-month momentum, we can see that my models actually performed, about 4% or 5% worse than the naive model. But for market adjusted momentum, my models actually performed about 15 to 13% better on average. And this makes sense because the market has been on an historical bull run for the last decade or so. So the naive model was expectedly very accurate for 6-month momentum. So, what did these results actually mean? They show that my models, although not perfect across all momentum definitions, they may be able to teach us something about market adjusted momentum, as evidenced by the positive figures there. So did language metrics actually improve my model's accuracy, right? Did language metrics actually show promise in explaining stock momentum? Well, again, from the figures here, we can see that on average for 6-month momentum, for random forest, it actually only improved accuracy by maybe about 2%, but for support vector machines, language metrics decreased model accuracy by 2%. And then we kind of see a similar figure, or even worse, a worse picture when looking at market adjusted momentum. For random forest, model accuracy actually dipped about 3% when using language metrics, and improved by a very marginal, less than 1% for support vector machines. And although I don't have the data on the slide here, there was a big deviation among companies themselves. So for example, language metrics improved momentum predictions for General Electric across the board by a pretty large margin, but they hurt prediction accuracies for United Health Group. So there appears to be maybe some industry specific reliance here, but it's tough to say with my small sample size. And so at the end, the only thing we can say is language metrics sometimes help. There is some pattern, but we can't really tell from my small sample size. And when changing the window size or how much historical data the model actually incorporated, we see in general a larger window size or more historical data typically improved model accuracy. And that's very evident with 6-month momentum here. But with market adjusted momentum, we see a bit of a rise here, especially when we go from 1 quarter to 2 quarters, and then it kind of dips down again and stays kind of stable. But one thing that is for sure common between all of these is that the 1 quarter window size, or the smallest window size, is the least accurate. So this suggests that quarter to quarter momentum is too volatile to accurately predict. And one thing that you may be asking is, by looking at these raw accuracy figures, is that are these accuracy percentages good? And the short answer is that there is no universal baseline. And the only way to really get a sense of what that kind of baseline would be by calculating more advanced accuracy metrics. And perhaps through, we could get that by implementing some sort of trading strategy with these models. But that's beyond this time scope that I had for this thesis. But in general, models do better when incorporating more historical data. And lastly, when changing whether my models use delta input or the raw metric values themselves, we see a bit more of a clearer pattern. The positive values here indicate that when using delta input, my models were about 4.2% more accurate on average and 1.3% more accurate on average for 6-month momentum. For market adjusted momentum, it seems to help support vector machines by about 1.3% on average, but actually hurts random forest accuracy by about 2%. So although this doesn't have much implications for our understanding of momentum, it affirms that machine learning models like random forest and support vector machines can incorporate sort of temporal trends into their calculations, even if they cannot recognize these trends by default, like more advanced models. So at the end, here we can say delta inputs can help models recognize temporal trends. So that was a lot of info, but ultimately, what does it all mean? So even in my small application here, we saw evidence that both relatively simplistic models like random forest and support vector machines can predict momentum with a relatively high degree of accuracy compared to a naive model, especially for dealing with market adjusted momentum. And as machine learning and natural language processing techniques advance, our ability to capture information from press releases and earnings calls will improve and shed new light on market behavior. In terms of momentum, my results show conflicting results with no real discernible pattern. However, due to time constraints, I was only able to run my models across 12 companies in 6 industry groups. So future research would really benefit from running my tests across a lot more companies from a lot of different sector groups before we make any broad conclusions about whether machine learning or these factors I identified can predict stock momentum. Future research should also consider measuring the profitability of a trading strategy that uses these models' predictions. This will give more insight into how well these models practically perform and operate, rather than just the accuracy percentages I presented here that don't really have a clear baseline and it can't give a clear-cut answer for whether this is good or not. So even though my research was not able to show anything definitively, my results show that there is a promising path forward for the future of machine learning, artificial intelligence, finance. Thank you.